Imagine a sudden, dramatic downturn in financial markets, a truly rare and impactful event that seems to come out of nowhere. What if you could put strategies in place specifically designed to protect your investment portfolio from these extreme, unexpected shocks? Investors implement tail risk hedging as a sophisticated strategy to mitigate the potential for significant losses during these infrequent but severe market events. It is essentially an insurance policy for a portfolio, aiming to provide protection against the negative consequences of so-called fat-tail distributions, where extreme outcomes occur more frequently than standard statistical models might predict. The core idea behind tail risk hedging stems from the recognition that traditional diversification alone might not fully protect against systemic shocks. These extreme events, often called black swans, are characterized by their low probability of occurrence but high impact when they do happen. The why here is rooted in modern portfolio theory's limitations regarding non-normal return distributions and the interconnectedness of global markets, which can lead to widespread correlations during crises, undermining diversification benefits. Hedging these tails seeks to achieve an asymmetric payoff profile, generating substantial gains when the market plummets, which then offsets losses in the core portfolio. To practically implement tail risk hedging, investors typically employ a few key strategies. One common method involves purchasing out of the money put options on broad market indices, such as the S&P 500. These options become profitable only if the market drops significantly, offering substantial leverage and protecting a large portfolio with a relatively small premium. Another approach includes investing in volatility-linked instruments, for example, futures or options on the VIX index, which tends to spike sharply during periods of market stress. Additionally, some strategies involve allocating a small portion of the portfolio to uncorrelated assets or managed futures, which can perform independently of traditional equity and bond markets. A crucial insight for investors is that tail hedging is not about enhancing everyday returns. It is about capital preservation and risk management during extraordinary circumstances. It involves a continuous cost, the premium paid for options, which acts like an insurance payment. The benefit is often an asymmetric payoff, where small, consistent costs are incurred during normal markets in exchange for potentially very large payouts during a crisis. This deliberate cost is a trade-off for safeguarding against the worst-case scenarios, allowing investors to maintain their long-term investment objectives with greater confidence. Ultimately, effectively implementing tail risk hedging means strategically positioning a portfolio to survive and potentially thrive through periods of extreme market stress. It is about understanding the potential for rare, high-impact events and proactively building in protective layers. This approach allows investors to reduce portfolio volatility during crises and offers psychological comfort, knowing that severe downside risks are thoughtfully addressed, thereby improving overall long-term portfolio stability and resilience.